Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
Yeah, hello and good morning, ladies and gentlemen. A very warm welcome to today's BAI Webinar, which is on quantitative rating models and valuation of microfinance refinancing. Yes, this is quite a niche topic in our broad range of activities and topics at BAI. However, as you have seen, we have now a long tradition also focusing on microfinance topics. As an association, yeah, we have been involved in microfinance topics on national and European level, and we think it is also a dedicated investment topic which we want to promote further here in Germany. With regard to the microfinance topic, there are, of course, a number of specialities and specific challenges which are around the topics of ratings, valuations, and therefore we are quite pleased to offer you today this webinar, which we do in cooperation with IPConcept, our member, and FS Impact Finance, so that we can bring these topics to your attention. We have two distinguished speakers today. That's on the one side, Dr. Marc-Patrick Adolph, who is working in the valuation unit of IPConcept, and he will explain a little bit more himself about his activities. And secondly, this is Luca Soppelsa. He is leader of the risk and monitoring team of Frankfurt School Impact, Frankfurt School Impact Finance unit. And yes, so I'm very happy to hand over to the speakers, and I'm looking forward to a fruitful discussions with our participants today. Before handing over, let's briefly inform you that our next webinar will be on the 25th of February, which will be on fund secondaries in Corona-Zeiten. As you are aware, our theme of the month of February at our association's work will be fund secondaries and co-investments, and therefore we are happy also to host a specific webinar on this topic. So please pencil in the date in your diary, and we'll be in touch again there. And now I'm happy to hand over, and please, Mr. Adolph, please, Mr. Soppelsa, the floor is yours.
So, okay, thank you, Mr. Dornzeifer, for your brief introduction, and hello and good morning, everybody, from my side. I just want to give a short introduction of myself. Yeah, as Mr. Dornzeifer mentioned, I'm Marc-Patrick Adolph. I'm working for IPConcept, the management company in Luxemburg, which is a subsidiary of TZ Private Bank. Yeah, my daily work is mainly about how to value assets, and especially my main area is valuation of microfinance refinancing, and therefore I'm in contact with our clients who are who have funds with these assets in their portfolio. One of our clients is represented by Luca Soppelsa, which I want to give him the chance to introduce himself as well.
Thanks, Mark, and good morning, everyone. Also from my side, thank you all for taking part in today's webinar. My name is Luca Soppelsa, and I lead the risk and monitoring team of FS Impact Finance, company I joined in almost 5 years ago. Few words about the company. So We are a fund manager with a head office in Frankfurt. We are regulated by BaFin, German Financial Authority, as you all might know. We are a company specialized in impact investing with a particular focus on developing countries and emerging markets. Our investment priorities are centered around the United Nations Sustainable Development Goals, the SDGs. We have a strong foothold on in microfinance and SME finance, a sector for which we manage funds since, as a company since 15 years. But we also provide financing solution in other sectors, part of the broader sphere of impact investing. To give you some examples, we deal with sustainable energy, climate finance, circular economy, crowd investing, and also startup finance. This started being actually an exception to our fund portfolio, as it is the only fund that is focused on the German market and in particular on the city of Frankfurt. This in a nutshell from my side. Now I give the word back to Marc, who will start with the presentation on rating and valuation of microfinance institution. Thanks. Marc, the floor is yours.
Perfect. Thanks a lot, Luca, for your introduction. Yeah, as you said, we want to present you a quantitative rating model and valuation of microfinance refinancing, whereas the rating model is something we have developed in the last years, and we want to show you the advantages that can be possible if you derive such a rating model. I will start with these topics, and especially in the light of COVID-19, and Luca will follow up with a fund management perspective. I want to give you a brief overview over the agenda of today's webinar. Therefore, we start in the first section with the problems and the objective of this topic. So at first, what are the problems we are facing, especially in the fund universe? And after this, on the objective we set us and the aim of this webinar. This directly brings us to the two main topics. At first, the quantitative credit rating, which is essential for the valuation that is performed afterwards. So the valuation of the refinancing instruments of this microfinance institutions. This will be followed up by the results and the impacts. So we don't want to see only theory, we also want to see some results of the rating and the valuation. And as I've mentioned before, especially also the impact of COVID-19 on these two topics. And the last section will be provided by Luca, where he gives us some insights of this advantages for the fund management. Okay, then let's start with the problems we are facing. So there are two levels. The first level is the investment fund level. An investment fund needs to be calculated in some frequency, like on a monthly basis. And also the net asset value needs to be performed at a fair value, and the assets which are in the investment fund have to be calculated in a frequency that is also reasonable in comparison to the calculation frequency of the investment fund. And this calculation of the assets or valuation of the assets at a fair value brings us to the second level, which is below, it's the asset level. So the problem for microfinance refinancing is that you don't have any active market. So you can't go to a stock market like for Frankfurt Exchange and trade this refinancing and see some quotes or some other fixed income instruments at some brokers. So you don't have any quotes in market. So what's the only possibility for you? You have to derive quotes or values from a model. But to perform a model in the fixed income world, you have to have some credit rating normally. So when you, for example, using discounted cash flow model, you have to have some credit rating. And the problem in this situation is you don't have a credit rating in the market. Like the big rating agencies like S&P or Moody's don't perform the ratings for microfinance institutions. There are some ratings in the market, but these are not credit ratings. These are performance ratings. We've asked the respective agencies, and they said, okay, that's only performance ratings, and you can't derive any probability of default. So it's necessary for us to have our own credit rating and probability of default calculation. This brings us to one of the first topics, which is the valuation of these assets. So assuming there is some credit rating, there are the common methods displayed in this graph or in this figure. We can distinguish between two approaches for the valuation. The first one is the income approach. And below the income approach, there is the before mentioned discounted cash flow model or DCF model, how I will call it in further slides. On the other hand, there is the cost approach. Do not confound this cost approach with the approach in the real estate sector. With this cost approach here, I mean amortized costs. And if necessary, for amortized costs, you also have to use an impairment. We distinguish between three types of impairments. One type is general impairments. So, for example, you have something in your portfolio valued at 100%, and you use general impairments of 0%, 50%, or 100%, which you apply on this amortized cost. The second sector is recovery rate. So you calculate a recovery rate of a company which is not going concern anymore. But there are some issues with this, which we will deal with later on. And the last point is expected credit loss, where you calculate the expected credit loss of the refinancing. But the issue with the expected credit loss is you have to have some credit rating as well, which directly leads us to the discounted cash flow model as well. What was our approach in this case? So we have to calculate the credit rating. So we use the discounted cash flow model and want to combine both parts. We combine income approach and cost approach to get the advantages of a discounted cash flow model in comparison to the other three types of impairments, and use the discounted cash flow model to derive impairments. We will see later on what impairments we can derive from this one. So we use all the information we have, run a discounted cash flow model, and get the impairments and use it in the cost approach. Now we have seen the problems we are facing. So we have to calculate the discounted cash flow model, and therefore we have to calculate or derive the probability of default from this credit rating. And therefore, as we have faced the problems, we directly come to the objectives we have. Our aim is to have a rating which is up to date, so only with slight delays, which is due to reporting delays of the figures, and which is only based on quantitative factors. So we get information from the microfinance institutions with their balance sheet, their profit and loss and portfolio quality data, put it in the model and get some probability of default. So our aim is to have a focus on quantitative and solely quantitative factors, to ignore in the first step qualitative factors. And the objective with up-to-date credit rating is that we directly see if the situation is getting better, worse, or staying the same. And the other objective, or the second part of our objective, is the valuation part. We want to have a consistent and coherent valuation over time, in a manner that it shall be consistent between all of the refinancing for the MFIs we have in the portfolios. So one refinancing is treated the same manner as other refinancing and the other and so on. And all of them are treated the same way. And also, it shall be treated the same way over the time horizon. So you don't use one approach in the 1 month and then another approach next month. So it shall be something that is stable over time. And as we have defined our objective, we will start, or want to start with the first objective, which is the rating model. I want to show you the parameterization we are run in this model. So you see 5 clusters in here. These are driven by, or these clusters are driven by the information we receive from the microfinance institutions, like I've mentioned before, the balance sheet data, the profit and loss data, and the portfolio quality. And these can be clustered into 4 parts: the liquidity, the portfolio quality, profitability, and solvability. Under these clusters, we summarize several ratios. For example, a return on assets ratio, cash ratio, cost income ratio, and so on and so forth. And these clusters or these ratios are used in combination with the observed defaults, which is our 5th cluster, to derive significant predictors. So we put all of these ratios we have together, calibrate them against the observed defaults in the past, and receive the significant predictors or ratios, which can be used for future derivation of probability of default. So, for example, we run it once a year or once every 2 years, and so on and so forth. And then we get these predictors and can use it in the upcoming months or upcoming time horizons where we have to calculate the fair value for the investment funds. What is really important in this scenario is there are 2 points that are really important, and they both are hinting to the observed defaults. At first, you have to have some time horizon or past time horizon you view. For example, if you only have 1 year of past horizon, then it's a pretty short time frame to calibrate the values against the observed defaults in this time frame. And the second thing is you have to have a larger number of observed defaults. If you only have 1 default, it's pretty hard to derive the significant predictors or the ratios you use for future calculation. So you need some lower bound of numbers of observed defaults in the past. Since we have some clients, we had the possibility to observe some defaults in the past and to calibrate our model against these ones. Nevertheless, model only based on numbers is pretty great, but there might be some issues. And therefore, we have some sort of overruling, which can be used in this rating model. Here we distinct between 4 types, but they're not exclusively. There can be something in the future added to these ones. The first one is rating aging. So, for example, we don't get new data from microfinance institutions, and the current available data, like balance sheet data and so on, is outdated. So our rating model does not give us the right view of the actual or current probability of default due to this delay, and it does not reflect the right probability of default. And here we have the possibility to adjust it on a reasonable manner. A second type is natural disasters, like, for example, an earthquake or a typhoon. If the MFI or the microfinance institution says, okay, there is an earthquake in our country and we are affected, or our clients are affected by this earthquake, and we get some reasonable numbers, we can adjust the fact sheet data or the balance sheet data in accordance with the information we get, because there is some delay in this fact sheet or in the numbers we get, and with this adjustment we can have a really up-to-date credit rating. The third point are political and economical crises, like an oil crisis or a military intervention. A military intervention is something we have seen, for example, a few days ago in Myanmar. So if there is some exposure in Myanmar and the MFI says, okay, we are not affected, for example, then we don't have to adjust anything, because the current balance sheet data, profit loss data is sufficient. And the last point is a rather new one. It's a pandemic situation, a globally pandemic situation. And compared to the first three ones, three sections, which are normally more concentrated in one country or just a few countries, like for an oil crisis, COVID-19 in this part is a globally overruling we have to use. And if there is a pandemic situation, we have to adjust the numbers. So, for example, we have seen in the stock market and also in fixed income market in March a large breakdown, like 20% going back in the indices. And this has to be reflected, the situation, also in the credit rating of our microfinance institutions. These topics or these slides are for the rating model. Now I'd like to come to the valuation model. As I've mentioned earlier, the valuation model is a DCF model from which we derive impairments afterwards. As the name says of the DCF model, there are two parts. The first part is the discount factor, and the second part are the cash flows. The discount factor can be built by, or is built by, three components: the probability of default, the yield curve, and the credit agreement. Probability of default is rather easy. This is something we derive from our rating model, maybe with adjustments for some overrulings, but at the moment just say we derive it from our rating model. The yield curve is the curve of the currency in which the refinancing is granted. So if the refinancing is granted in euro, we use a euro yield curve. And the credit agreement seems to be mispointed at the discount factor. But it's pretty crucial in determining a discount factor, because from the credit agreement, we can derive the seniority of the refinancing. So whether it's a senior or junior, whether it's secured or unsecured. And this information about the seniority is crucial for the recovery rate estimation. And using the recovery rate we derive from the credit agreement, combining with the probability of default and making use of the credit triangle, we can derive a credit spread. This credit spread is combined at least with our yield curve, and from these combination of the three components, we get our discount factor. The second part is rather easy. It's the cash flows, for example, the interest rate payments, and we know when shall they be paid from the credit agreement. And combining these two components, so discount factor and cash flows, we receive our valuation, our DCF valuation, and can use this afterwards for the impairments. What are the advantages of the two parts, so the internal credit rating and the valuation? So at first, for the rating, we have a solely quantitative and MFI specific rating. an worsening or getting better of situation or a stable situation can be seen really quick. That's an advantage. And also, we don't use some sort of benchmark rating, or with this rating model, you don't have to use some sort of benchmark rating where you say, okay, MFI A, B, C do have this and that rating, and MFI D is nearly the same, and so we get the same rating. That's really MFI specific. It can also be used in risk management procedures. For example, in a value at risk model or in credit value at risk model. And the third point, which is not mentioned on the slide, is that you have some increased level of information on the side of the management company regarding the MFI situation. The second advantage or advantage block is the valuation part. So both bullet points presented in here are pointing towards the same situation. Clear advantage is that the valuation is based on only quantitatively determined probability of default, and therefore a granular and objective valuation is possible. In addition, the transparency of the reporting increases because it's rather easy to find out which valuation was derived. And which is also not mentioned on this slide is, or are the advantages compared to the other impairment methodologies. So the first impairment methodology is the granular impairments, or the general impairments with 1%, 50%, 100%, which is, yeah, not as good as this one because there are more granular valuations possible. The second one is the recovery rate estimation. There are two issues with the recovery rate estimation. The first one is, as I've mentioned earlier, it's only possible to apply this one if the company is not a going concern anymore. The second issue is that you have to make some assumptions regarding the asset and liability side. So how much of the assets are depreciated, and on the liability side, for example, where am I standing compared to other lenders, and where do I, and is there some interest forgiveness or anything else? And the third impairment possibility was the expected credit loss. So currently we are the same situation like an expected credit loss, and we have a credit rating, so an expected credit loss would be available as well. But the problem with the expected credit loss is that you do not look at interest rate payments. So, for example, if you have an MFI with a higher PD, or probability of default derived from our model, but you have negotiated a larger interest rate payment, for example, interest rate payments of 10% per year or something around this, then you have some risk adequacy interest rate, and you have a valuation at 100%. The interest rate payments are not included in the expected credit loss, and therefore it's not as good as a discounted cash flow model in this way. Okay, then I think it's enough of this theoretical part. We want to see some results. At first, we have 4 slides or 6 slides with graphs, 4 that are built up the same way as this one. So I just give a brief overview how this one is built up. The inner circle is January 2019. The outer circle is December 2019. And we have 20 rating grades, ranging from grade 1 to grade 20, where grade 1 is the best and grade 20 is the worst. Grade 1 is the dark green, and grade 20 is the nearly white. What is important, or what is cautionary in this scenario? Do not confound rating grade 20 with a rating of D from S&P, for example. Rating D from S&P stands for default. A rating grade 20 is not necessarily implicating a default. So this is ranging, for example, from something around 15% to 100% probability of default, whereas rating grade 1 is rather smaller. So you see these rating grades are not equidistant distributed, or the thickness is not equidistant. What is the main thing we see in here? Rating grade 1 stands for nearly 50%, or around about 50% of the whole portfolio. And the rating grade 20 stands for around about, let's say, 10%, 10 to 13% of the portfolios. And it seems that between these two extreme rating grades, it is rather well distributed. Now we have seen this rating grades, and it's important to see what's happening with the valuation, with or what is the implication of the rating grades on the valuation. And it's something you don't see in this graph, and which I want to tell you is that the migration between the rating grades is rather low. So there's not a huge volatility in the valuation, which can be seen in the next slide. Here, the inner circle as well is January 2019, and the valuation ranges from 0% to 100%. Here you see the impairments that are used, and it's rather interesting that even if only the half of the portfolio is in rating grade 1, about nearly 90% of the portfolio has a valuation of 100%. So even in lower rating grades, you get a valuation of 100%. And this is also combined with the thing I said earlier, with the risk adequacy interest rate. And only 3%, or around about 3% of the portfolio is in the lowest impairment clause, so has a valuation of 0%, but these are mainly microfinance institutions that are written off. Okay, this was the situation in 2019. And now it's interesting to see what's happening in 2020, especially in the light of COVID-19. And therefore, I have two questions prepared for you, which I would like you to answer. And maybe that you get a better feeling, or also a feeling of this rating grades and the valuation. There are, as I've said, two questions with around about 20 to 30 seconds per question to answer. You see, per question are 3 possible answers. The first question is, how much does the average rating change or deteriorate as a consequence of the COVID-19 pandemic? The 3 possibilities are less than 2 grades, between 2 and 4 grades, and more than 4 grades. And the second question is, how much does the average valuation change or worsen as a consequence of the COVID-19 pandemic? There are the possibilities: less than 5 percentage points, between 5 and 10 percentage points, and more than 10 percentage points. Then I would like Mr. Brooks to start the questions.
So the results should come slowly. Okay, so I will close it now.
Okay. That's pretty interesting. We will see in the upcoming slide which one is right. Mr. Brooks, you also open the second question, or shall we wait?
Yeah, I will do. Just a moment.
Perfect.
So I will close now this question. Wait 10 seconds. Okay.
Perfect.
So do you see the result?
Yeah, I've noted the results and I've written them down. Thanks a lot.
Okay.
Perfect. So the distribution between the three answers was 45, 50%, and 5%. Yeah, most of you are right, or the half is right. There it is. So the rating grade pre-COVID-19, so in January and February, has been at 6, the average rating grade, and it deteriorated to 8.89 since March, so from March to December. And yeah, that's 50% of you said between 2 and 4 points, so that's right. What's rather interesting in this graphic, January and February had shown the same picture as in 2019, not really surprising. But in March, with the outbreak, or let's say with this global pandemic situation and the moratoria that started and the economic lockdowns and so on and so forth, we had to apply overruling, which is dependent on the country in which the respective MFI sits and operates. And therefore, we used some yield curve of the countries. And you see that the rating grade deteriorates, so especially rating grade 1, from around 50% to 7%. This held through from March to May. And afterwards, as we got newer results of the microfinance institutions, which displayed the whole situation of COVID-19 and the impact on their portfolio, we lifted this overruling, and rating grade 1 increased significantly to 35%. Interestingly, the rating grade 1, or the microfinance institutions in rating grade 1, decreased over time till December to 30%. And on the other hand, when we look at rating grade 20, there with this uplift of the overruling from May to June, it only decreased from 14 to 10%, but afterwards, till December, the rating grade 1 grows bigger and bigger, even bigger than during the time when we applied this overruling. And it seems that the rating distribution is also well done over time. And now that we've seen these huge jumps here and here. We want to see what's happening in the portfolios or with the valuation. So, there it is. The impact of COVID-19 or this. Oh, I'll start with the answer of the question I've given you. You have said, okay, 33% have said that the shift is less than 5 percentage points, 41 between 5 and 10, and 17% more than 10. And we see the average valuation in January and February have been at 95.6% and 96.37%, sorry. And from March onwards, it was at 95.61%. So the average valuation only decreased a bit, not really much. And we see from February to March, the part of the 100% portfolio decreased for sure, and the lower valuations increased, but not this significantly to have some large impact on the average valuation. We again see a jump from May to June, where the part of the 100% portfolio increases, but not towards the level we had in January. And from this on, there have been some worsening of the valuation, but this worsening is still on a really, really high level. So this bucket and this bucket are standing for the 95% parts. So they're only slightly devaluations, but they give a hint of a second wave that is hitting all countries, not only the countries where the MFIs are sitting, but we're seeing the same in Germany, for example. There are second waves and there is some economic slowdown. Okay, now we have seen separated the part or the results for 2019 and 2020. And now we want to see them combined, not in a graphic like before, because this would be not sufficient. We look at this graph here. There are 3 portfolios, and we have fixed the valuation or the average valuation in 2019 at 100%. And there we see some sort of steady increase for all portfolios. This might be in some way misleading, because if you have a pretty good portfolio with all of the microfinance refinancing at 100%, then there is no possibility to get better. So only if there are some constituents with a valuation below 100%, you can increase in the average valuation. And what do we see here with this red part? This is the time when we use the overruling for COVID-19, and especially when the global outbreak happened. And there we see some deteriorating for 2 portfolios. One was rather stable. This was, as I've mentioned earlier, is mainly based on the fact of the exposure of the portfolio. So in which country are the MFIs sitting, in which you have granted refinancings. But nevertheless, after this outbreak, there was some sort of bottom building and a going up of the average valuation again. And as I've mentioned, there is some sort of second wave we can see in the credit rating and in the results. I skip to the next slide. The previous slide only had this valuation part, but now we want to see what's happening with the net asset value per share, or the NAV, because there are also interest rate payments which are not displayed in the previous graphic, but they are still coming into the portfolio, and also there's some cash position in the portfolios. From 2019 onwards, we have some sort of steady increase, and all of the portfolios are at the same level or nearly the same level in February. And afterwards, there was this breakdown where 2 portfolios are mainly affected. But as we've seen earlier, rather a steady increase afterwards, or jump back to the previous levels, and also coming more than or having a higher level than the pre-COVID outbreak, and the second wave can be also seen here. But nevertheless, just all of these jumps are at a really low volatility. So you have something around 102.5% to 100%, whereas the stock indices had a rather higher deterioration. For my part, summarized, I can say with an internal credit rating based on this quantitatively factors, you can get some sort of a low volatility and some up-to-date information, and have a grip on the situation of the microfinance institutions. With these words, I would like to give the word to Luca Soppelsa, that he can show you something from the side of the fund management.
Thank you, Marc. So, yeah, before we close off this webinar, I would like to take the opportunity to add a few words from the fund manager perspective on how, together with our colleagues of IPConcept, and in close and constant cooperation, we try to add value to the rating and evaluation of microfinance institution. This is a bidirectional process, so it works in both directions. First, on the one end, we as fund manager, in line with IPConcept objective to have an up-to-date credit rating, as Marc has been explaining in his presentation so far. We provide information, latest up-to-date information directly from the clients and the country. So it's important to say we have hands and feet on the ground with investment managers located in many of the countries where we are invested in. And this is quite important because it allows us to have non-filtered first-hand information. This has been particularly relevant in 2020, as you can imagine, and continue to be so in light of the global COVID pandemic. To give you an example, for instance, as a result of the COVID pandemic, local regulators decided to act in different ways and introduced different measures to support the financial sector and the financial sector players in the different countries, and also allow different ways of treating loans to end borrowers that were impacted by the COVID pandemic. To bring an example or a couple of examples on how things were different, what we are seeing in countries like Kosovo, for instance, central bank imposing a mandatory moratorium, which allowed financial institutions to consider COVID restructure loans that they were providing to the end borrowers, so to the small entrepreneurs and SMEs there in the country, to consider these loans as part of current portfolio, even though they were restructured, and in turn allow the institutions, the microfinance institution, the banks, not to build extra provisions for these loans, which is of course quite important because, as you know, provision have an impact on the profitability at the end of the day, and therefore directly or indirectly then also will have an impact on the valuation of the institutions. There have been other countries that had a completely different approach, like Nicaragua, where the regulator decided not to introduce any moratorium. And another case, which we have seen also in several countries, was, and I can bring here the example of Mongolia, a case where the central bank introduced only an implicit moratorium. What does it mean? This was only a recommendation by the National Central Bank, which was not legally binding for the banks and microfinance institutions in the country. So it was up to them to decide whether or not to support the end borrowers with any loan restructuring, but at the same time without having necessarily the same support in terms of provisioning that we could have seen or we have seen in countries like Kosovo. Another example of how we provide further input and support the feeding of the model is as fund manager, but we participate in lenders group discussions, deal with loan restructurings, payment deferrals, and this has been, as you can imagine, quite a big topic in 2020 with the COVID pandemic. There's been a big wave of international group negotiations, which in which, as a result of the moratoria that the financial institutions were giving to the end borrowers, led to a situation where also MFIs were running into liquidity problems. They were not seeing their loans being repaid. At the same time, they needed to repay the liabilities to either local or international lenders. So we have seen quite a wave of payment deferrals, on average between 6 and 9 months. So yeah, this to give you a couple of examples on how we try to provide further, always up-to-date information that can be fed into the model. And but at the same time, as I said, it's a bi-directional process whereby we also get big added value from the colleagues of IPConcept that and the evaluation team, with whom we can, for instance, pre-check valuation of upcoming disbursements. Based on the latest financial information that we receive from microfinance institutions, we can have Marc and his team run these numbers through the model and have already an idea before we disburse the loan whether an upcoming valuation can be already at 100%, or we can expect some impairment, or there is quite big leeway before we would ever go to an impairment situation, which is of course important because it can help us in decide whether we want to, for instance, postpone a disbursement, waiting for better timing and better financial performance of the institution, or if necessary and also, if possible, of course, see whether we can negotiate any adjustment to the loan terms to make it more favorable and push up the valuation of the loan if possible. So this just a few examples from my side on how we cooperate with Marc and his team, as I said. Of course, if you have more questions at the end of the presentation, then feel free to ask. I now want to thank you again, everyone, for your attention today, and I will give the word back to Mr. Donscyfer, who will introduce us to the Q&A of this webinar. Thank you very much.
Yes. So this is again Frank. Yes, thank you very much for your presentation, and maybe two questions to start with. In the context of your sustainable finance initiative and the discussions about new obligations with regard to transparency and reporting, I would like to know, so how does this affect the microfinance industry, and especially with regard to the fact that the overall work on the sustainable finance initiative is currently mostly focusing on so ecological issues rather than social topics. And so that is a second question. how will this affect also microfinance business in the future? What things are likely to happen? And what are the areas where you see the most concerns? And also really to be more precise on the first question, so the data availability, so how do you get the information? And how are you able to let's say prepare and evaluate the data you get for the investors?
I would like to start. I think this topic is mainly for Luca, but just for the data point of view, normally it goes the way that Frankfurt School or FS Impact Finance or other clients get the data from the microfinance institution in some format. We said, okay, we need it in this and that format as an Excel file, for example, and process it the whole way from the fund management to IPConcept, and there we work with this data we gathered.
Yeah, but so how do you, who's preparing that data? Who is going to validate the data? Because I think this is one of the crucial points. So at the end also the reliability of the data.
Yeah, for the data we receive, we have some quality checks where we run this. We run these checks on the data we get, and afterwards talk with the colleagues from FS and clarify the issues we have seen. And the data is provided by the microfinance institution. And we can also check this data based on the financial statements that are audited and have some cross checks on these ones.
Okay.
Maybe then I also can add that as part of our due diligence process, of course, we have investment managers that, as I was explaining in the presentation, are based in the countries. Of course, not all countries, but definitely in the region. And as part of the due diligence, before each and every investment, they actually go and meet the client. They visit not only the headquarters but also branches and clients of the microfinance institution. So a first check is already done at the initial phase, pre-disbursement. But then, of course, there is, as Marc was saying, constant flow of information, which goes beyond the pure financial information, but also has to do with more the social and qualitative indicators.
Okay, so that sounds that you are quite confident that you are able to comply with all these transparency and reporting requirements, very detailed analysis of data, which then must be submitted to either the regulator or to the investors.
Yeah, I mean, we, as now I speak for our fund, for instance, microfinance fund, that we manage, even as I said before, we do an investment, the institution needs to fulfill some positive criteria that before we can invest. We check for negative criteria. There are a series of ESG related checks that are performed. So yeah, that is definitely done. And this topic now, in light of the new EU taxonomy and sustainable finance disclosure regulation, will become more and more important. But yeah, I'm confident that given the work that we do on the ground and with our clients, you know, this will actually help us to grow our funds even more, and help bring people to even become more conscious about in which funds to invest with, because there will be indeed more transparency and more ability to actually compare funds in that respect.
Yeah, okay. No, quite helpful. We have a couple of questions also from participants. I would go through them. First, how do you capture future expectations in your rating models? How do you adjust this through the cycle PDs into point in time PD for ECL model?
So future expectations are currently not in this model, and they shall not be put into. This has the easy reason. We have this data and we calibrate it on past defaults. So we have for all of these defaults also the balance sheet or the profit and loss data, and can say, okay, these and that factors are relevant in determining the future default. And so therefore we do not inherit the upcoming values. This has another reason. The other reason is how reliable are the plannings of the microfinance institutions. There must be some checks, and there can be some exogenous factors which we can't put into this model, or currently not can put into this model. And yeah, this one is a 1 year probability of default we determine and just use it in the DCF model. Therefore, we don't run an ECL model currently.
Okay, the next question here is, how do you include the impact for political crisis in the model? How is the readjustment take place?
Okay, I can just give an example that comes to my mind. We have a political crisis in some country, and due to this, the microfinance institution says, okay, there are 20% of our clients, or the loans we have granted to the clients, which might default for this and that reason. And as a consequence, we have to change the portfolio quality, for instance, and if this is a significant predictor, we get another probability of default directly, and not only a few months later when there is the real effect in the portfolio, or if there is some sort of microfinance institution who has some new regulation, and therefore they have to change or have to have some more provisions, and we can adjust for these ones if we find out that the provisions are only driven by regulator and does not reflect the real situation. That's for example.
Yeah.
So I can't give you an explicit example because they are rather they don't happen this often.
Yeah. Okay. And another a good question is, of course, here the following. In your opinion, what are the main reasons for the credit and valuation stability of the microfinance institutes in the context of COVID-19 crisis, especially in relation to other asset classes?
There are, I think, 2 points I would like to mention here. The first one is also something the fund management told us. The microfinance institutions are not this largely connected with the overall situation in the country or with the banking situation in a country, and are rather stable. And the other point is, which is way more relevant for this one, is that the interest rates that are paid in the refinancing are rather high. So if you pay 1% interest rate and the PD increases slightly, then you directly have an impact. But if there is an PD of, is there an interest rate of 8% and the PD increases of around about 2%, nothing really happens. And that's nearly the main reason for this one.
Okay. Yes, there are a number of questions, so I'm very happy about that. So the next one, do you see similarities among MFIs in different emerging markets? So when calibrating the significant factors, have you observed similarities in the prediction power of the rating factors across different EMs, for example, here in Middle East or Latin America?
There, I have to have a deeper dip in the numbers to answer this correctly, but there are some similarities. So as we use ratios for this one, most of the ratios are pretty stable among the countries. Even if you go from EM country 1 to EM country 2, there are only some of the numbers which are, or ratios which are country dependent. So there are some similarities between the countries.
Yeah. Okay. The next question. Is there a difference between country risk solvency of the Microfinance Institute and currency risk?
The currency risk, we don't currently look at currency risk because this is something on the microfinance institution. As we value the refinancing, which is normally granted in euro or US dollar, currently we don't focus on this one. Liquidity risk is also something which we have looked at, especially in some situations. Luca knows this. We had 2 MFIs or 1 MFI in the past where we have seen that there might be some liquidity issue and where we have used some sort of overruling to account for this one. But yeah.
Yeah, liquidity issue was, for instance, the example I was giving before, last year when the majority of microfinance institutions had to deal with moratorium that either were mandatorily introduced by their local central banks or recommended with this implicit moratoria. They all of a sudden found themselves in a situation where they didn't have cash flow incoming anymore, but still had monthly expenses and liabilities to pay, which led them very quickly in a shortfall of liquidity, and started this wave of negotiations with the lenders to restructure their payment schedules.
Okay. And questions are going on. Can you please explain the difference in performance, i.e. NAV, across the 3 portfolios you showed?
Yeah, as I've said, in the first graph, there is this valuation fixed at 100% for January 2019. And if the portfolio is rather good in January 2019 and consists of mainly refinancing with 100%, then for instance, even if the other refinancing go up to 100%, on average, you don't get so much better. And if you have, like, for example, 10% of your portfolio is at 25%, and this goes up and up and up, your average valuation also goes up and more in comparison than the portfolio with this rather good starting point. There's some issue with fixing at 100%. And I included a graph with the valuation of with the NAV per share to also reflect cases of interest rate payments which are not reflected in the valuation graph, and the cash the portfolios had. So the cash is even in a downturn is staying at the same rate. And therefore, I also included this one. And these are the difference between the portfolios. So one portfolio started at a pretty good starting point, and or two portfolios started at a pretty good starting point, and one portfolio at not this good, but nevertheless a good starting point, and had the possibility to grow in valuation even more.
Okay. So if I may add, Patrick, I think, Mark, I mean, the composition of the funds can also be different. And I mean, there can be funds that have more or less share of senior loans or junior loans. So there can be funds that have a bit more equity exposure. So there are, you know, many different variables at play that can have an impact on that.
Okay. Luca, for you, one question is also here. In what seniorities does FS Impact Finance invest in?
Most of our investments are senior loans. I would say approximately 90%. Yeah. We have some equity investments for the funds we manage and a couple of subordinated loans, but mostly we are talking about senior unsecured loans.
Okay. I think as there are still a number of questions and I'm cautious of the time, I will pick up two further questions, and all those who have further questions or which questions we could not pick up right now, kindly refer to both speakers directly with your questions. They are happy to take the questions afterwards. But for the moment, let's continue with two further questions. One question is, should not the model aim for a through the cycle model to avoid short-term volatility?
Sorry, I haven't understood the first part. Can you?
Okay. Should not the model aim for a through the cycle model to avoid short-term volatility?
Yeah, it's a rather good question. I have to think of.
Or you can contact the person afterwards as you prefer.
I think this would be easier. This gives me some more time to give a correct answer and not saying, okay, this and that sentence, and then it's fine.
Yeah, then here I will just pick this one here. Why are here microfinance institutes rating included in your model? If an MFI goes bankrupt, his business will be acquired by, for example, another bank. Nothing should change in the borrower's risk.
No, not necessarily. Yeah. I would say it's not. Sorry, Mark. I wouldn't. I mean, it's not the factor that if an institution, if a microfinance institution goes into default, there will be a bank buying over the portfolio or whatever is left of the institution. There can be many reasons that can lead to a default of a microfinance institutions, but of the cases we have seen in the past where there was defaults of microfinance institution in the last 10-12 years, I think that there are some cases where the portfolio was taken over by mostly other microfinance institutions, larger ones, but it really depends on which kind of default we are talking about. Yeah.
And sometimes there's also a liquidator coming in or stepping in, and then there's just a liquidation of the microfinance institution.
Yeah, that.
Exactly. I mean, the cases of takeover usually are mostly cases where the institution is not yet in default. Maybe it is struggling, maybe it is running into some difficulties, or maybe just the shareholders have a good opportunity to sell. But if there is a pure default that the institution runs into bankruptcy, or as other reason why it goes into default, such as a fraud case or any other case, I mean, it's not so easy to see a takeover or a purchase of the institution.
Mm-hmm. Okay, so as there are still further questions, which is really good and shows that this is a very relevant topic, and a lot of our participants are really involved in this topic. I can repeat me and tell those questionnaires, please go and get in touch here with the two speakers directly. They are happy to further discuss that with you bilaterally. And I think the presentation will be available soon on our homepage, and all further points and issues, please refer to the speakers. From my side, I would like to thank you, both of you, again. That was a very technical topic today, however, I think quite interesting, and as we saw, with quite some relevance for our participants. We had almost 100 participants for the topic, and that's very remarkable. So thank you very much again, and I wish you a splendid day. And yeah, please make sure you attend our future webinars on a lot of different topics around alternative investments. So have a nice day. Goodbye.
Thanks.
Thanks, everyone. Also from our side, have a good day. Thanks for participating.